Good afternoon, everyone, and welcome to our third quarter call. At Hudson Pacific, we spent nearly 2 decades acquiring, transforming, developing, leasing, and operating premier real estate and related services in the most sought-after locations, catering to dynamic tech and media industries. Over the last several years, our talented team has worked diligently to leverage the strength and resiliency of this unique platform to rise above the multiple, unprecedented, once-in-a-generation challenges impacting our core industries and markets. As we sit today, we are gaining additional confidence that the tide is turning. While more time is needed, we believe that as we exit this year and move through 25, we will stabilize our portfolio and be positioned for a return to growth and ultimately outperformance. The positive office-related indicators that are emerging are numerous. The data clearly shows that office-oriented cultures enhance productivity and performance. And with the U.S. facing the steepest decline in white-collar productivity in 50 years, the push to 4 or even 5-day work week has begun. Today, only 1% of the Fortune 100 companies still have fully remote office attendance policies, and 80% of the CEO respondents in KPMG's most recent survey anticipate their work will be full-time in office in the coming years. And this movement, which had early traction with financial companies on the East Coast, is now gaining momentum among tech companies along the West Coast. Recent full-time mandate announcements include Seattle's largest employer, Amazon, Dell, and San Francisco's largest employer, Salesforce. Underscoring the momentum in San Francisco, in September, Muni ridership surpassed 520,000 average weekday boardings and approximately 75% of pre-pandemic levels, with certain routes recovering to well in excess of 100%. And to that, tech layoffs are slowing, venture fundraising is picking up, and after years of cost-cutting, venture investors are finally advising portfolio companies to get back out on the offensive. Tech layoffs have consistently declined since the first quarter of 2023, now reaching their lowest level since second quarter of 22, a 45% improvement year over year. Furthermore, AI companies, 44% of which are in the Bay Area, have brought venture investors back to the table. 2024 is on pace to be one of the best years for AI funding on record, with the lion's share going in the Bay Area, which we expect to provide another leasing catalyst in the coming months. AI companies tend to be office first, and since January 2022, have leased 2.3 million square feet in the Bay Area, a footprint Cushman & Wakefield expects to grow 200% over the next 2 years. At present, we're monitoring 25 tenants in the market seeking about 800,000 additional square feet. Big picture, a recovery that has already taken hold on the East Coast is now gaining traction on the West Coast. And in the third quarter, tenant requirements in the West Coast, tech-centric office markets increased 17% year over year compared to just 7% for the broader U.S. office market. Downtown San Francisco had positive net absorption for Class A product for the first time in 2 years. And year-to-date overall gross leasing is the highest since 2019, with tenant requirements up 20% year over year. The San Francisco Peninsula has also had its first quarter of positive net absorption since 2022, and software and internet companies led leasing volume, representing 42% of the top 25 transactions. And in the Valley, office occupancy losses are starting to recede, and tenant requirements are up 33% year over year. And in Seattle, we're now seeing mid-sized demand coming back to the market, with overall requirements up about 30% year over year. All of this activity mirrors what we're experiencing with our own office portfolio. Now turning to studios. The following 3 months of Los Angeles show counts has been approximately in the low 80s. Production has started to pick up, nearing 90 shows during October, on trend with stronger demand we are seeing for 2025. While we are moving in the right direction, Los Angeles production has yet to return to any sense of normalcy, which continues to limit demand for our stages and services. Los Angeles is still the worldwide leader in film and television production, but to win back productions in an increasingly competitive, cost-conscious environment, we must have the appropriate financial incentives. Fortunately, office officials in the public realm at all levels have recognized this. And a few weeks ago, Governor Newsom introduced legislation that, if passed, would more than double the tax credit program to $750 million, making it the largest in the United States. This is a very positive development, and if passed, will go into effect in mid-2025 at a key moment when many companies such as Netflix envision production to be back to normal. We think new soundstage supply will remain limited, and a comprehensive offering of studios and services will be poised to successfully capture incremental demand, which typically builds ahead of production. We remain confident our studio team is the best in the business and recently promoted 2 senior executives in recognition of their growing responsibilities. Stephanie Bourne, who joined Hudson Pacific in 2021 from Disney, has been promoted to EVP Studios with oversight of sales, production services, operations, and strategic initiatives. And Ann Mertens has been promoted to EVP Studio Real Estate and Southern California Office Operations, having led at different times those functions for over a decade. I know both, alongside with our team and the broader studio leadership team, will ensure we continue to benefit from the creative strategies, streamlined operations, and exceptional level of service for which we are known. Finally, I want to just talk about capital recycling. With Fed policy easing and office fundamentals improving, transaction volume across our markets is accelerating. We are strategically tapping into this demand as a key component of our effort to deleverage with a focus on completing additional non-core office asset sales where we can maximize value. Of note, our Bay Area assets are garnering strong buyer interest, and as of the third quarter, we're under contract with a buyer that has gone non-refundable on Foothill Research Center in Palo Alto for $23 million. We've opted to sell at an attractive price per square foot rather than continuing to invest in this asset. Inclusive of Foothill, we presently have 3 sales under contract, another 3 under negotiation, which have the potential to generate gross proceeds totaling $200 to $225 million. In addition, we have begun discussions with potential partners and lenders on a portfolio of 6 office assets as both a secured financing and a joint venture opportunity, and we're optimistic the related transactions could close early next year. And we look forward to providing much more detail and additional updates. With that, I'm going to turn it over to Mark.
Thanks, Victor. We had another strong quarter of execution from our leasing team, signing 539,000 square feet of office leases, with 56% being new deals. This brought our year-to-date total to 1.6 million square feet, or 25% ahead of this time last year. Our priority has been to stabilize and grow occupancy, and this quarter we reported occupancy sequentially 40 basis points higher at 79.1%, along with a consistent lease percentage at 80%. In addition, if we adjust for the 100% leased and occupied Foothill Research Center, which we designated as held for sale in the third quarter, sequentially our occupancy increased 60 basis points to 79.3%, and our lease percentage increased 20 basis points to 80.2%. Our lease economics are improving or stable, with third quarter net effective rents 3% higher than our trailing 12-month average and only 4% off our pre-pandemic trailing 12-month average. We have continued to extend lease term, which in the third quarter was approximately 6 years, slightly above our trailing 12-month average and 42% above our trailing 12-month average a year ago. While we reported GAAP and cash rent spreads 11.5% and 13.3% off prior levels, but for a 29,000 square foot short-term lease in Los Angeles and 2 mid-sized Bay Area leases totaling 68,000 square feet, one in Palo Alto, the other in downtown San Francisco, our GAAP and cash rent spreads would have been essentially flat. In short, as average lease terms continue to lengthen and TIs and free rent remain in check, our net effective rents have held up even by comparison to pre-pandemic periods, in spite of the occasional setback on rent spreads. Our leasing activity pipeline, including deals and leases, LOIs, or proposals, remains robust at close to 2 million square feet, about 70% of which are new leases. Quarter over quarter, our pipeline in Seattle and Silicon Valley has increased, in part attributable to an 18 to 20% increase in requirement size in those markets. Tours remain active at 1.3 million square feet during the quarter, with a nearly 50% increase in Seattle, which is indicative of the level of interest we are seeing at our recently completed Washington 1000 development. To date, we have toured tenants through that project, representing a total of 700,000 square feet of requirements, which range in size from 35 to 150,000 square feet. Feedback from Seattle's top brokers during the recent dinner we held at the asset underscores Washington 1000's superior quality and leasability, only further enhanced by recent market strengthening. Across our office portfolio, if we sustain our leasing momentum of roughly 500,000 square feet per quarter, which our pipeline and tours suggest is reasonable, we expect occupancy to stabilize by the middle of next year with the potential for meaningful occupancy growth thereafter. We have about 670,000 square feet remaining to expire by year end. This includes 140,000 square feet at Met Park North, where the full building tenant recently exercised their right to terminate the lease. We are actively exploring options for this asset, which include early discussions with multiple tenants for 30 to 100,000 square foot requirements. Our coverage, which includes deals and leases, LOIs, or proposals, on remaining 2024 expirations is 37%, which increases to 55%, accounting for leases and discussions. This is not surprising given that, apart from Met Park North, our average lease expiration is roughly 7,000 square feet, and delayed decision-making is typical for these smaller tenants. As we look to 2025, excluding the full building lease at Foothill Research Center, which is held for sale, we have less than 1.7 million square feet expiring, or 16% of our ABR. Our remaining top 5 expirations next year collectively total 660,000 square feet, and we have approximately 64% coverage. Beyond that, our average expiring lease in 2025 is roughly 6,000 square feet. Turning to studios, in the third quarter, our in-service stages were 76% leased during the prior 12 months, down 220 basis points sequentially, reflecting the previously discussed single tenant vacating last year. Note this lease percentage excludes Sunset Glenoaks, for which there is not yet trailing 12-month data. Our Quixote stage lease percentage was up 60 basis points sequentially to 33.4% due to increased commercial shoots at our Quixote West Hollywood and Griffith Park locations. Compared to a year ago, our third quarter studio revenue was $5.6 million higher, even as we had a sequential $8.5 million decline due to lower average production levels in the third quarter compared to the second quarter, primarily affecting our studio ancillary and transportation segments. We currently have signed leases, are in contract, or have client interest on 79% of our film and TV stage square footage, or all but 14 of our 59 film and TV stages, inclusive of Sunset Glenoaks. This activity includes a notable increase in what the industry calls holds, essentially expressions of interest for specific stages for 2025 production dates. Similarly, coincident with a modest improvement in production activity late in and subsequent to the third quarter, we have seen stage leads and tours increase, and transportation and location services utilization has improved. We are optimistic these are early indicators of sustained stronger demand next year. Finally, I will touch on development. We have one active development project, Sunset Pier 94 Studios, which will be the first purpose-built studio in Manhattan. Construction is progressing on time and on budget for an anticipated delivery by the end of next year, and as of October, we have no further equity contributions. We are in active discussions with a leading studio as well as other productions on multi-year agreements for one or more stages. And with that, I'll turn the call over to Harout.
Thanks, Mark. Our third quarter 2024 revenue was $200.4 million compared to $231.4 million in the third quarter of last year, almost entirely due to the sale of One Westside and the expiration of the block lease at 1455 Market, partially offset by improved studio revenue following the resolution of the related union strikes. Our third quarter FFO, excluding specified items, was $14.3 million or 10 cents per diluted share, compared to $26.1 million or 18 cents per diluted share a year ago. Specified items for the third quarter totaled 5 cents per diluted share, consisting of a $3.9 million one-time straight-line rent reserve related to the transitioning a tenant to cash basis reporting, a $2.2 million non-cash revaluation of a loan swap unqualified for hedge accounting, a $1.2 million non-cash deferred tax write-off, and a $0.3 million transaction-related expense. The year-over-year change in FFO, excluding these specified items, was mostly attributable to the factors affecting revenue and lower FFO from non-controlling interests following our purchase of our partner's interest in 1455 Market earlier this year. Our third quarter AFFO was $15.8 million or 11 cents per diluted share, compared to $28.1 million or 20 cents per diluted share in the third quarter last year, with a change largely attributable to the previously mentioned items affecting FFO. Our third quarter same-store cash NOI was $96.9 million compared to $113.2 million in the third quarter last year, mostly due to the tenant move-outs, including Block at 1455 Market. Turning to our balance sheet. As Victor noted earlier, we are proactively pursuing multiple paths to increase liquidity, including asset sales, JV partnerships, and secured financings. We have no debt maturing until November 2025. Our share of net debt relative to our share of undepreciated book value is 37.4%, and our percentage of debt fixed or capped is 91.5%. At the end of the third quarter, we had $696 million of liquidity, comprised of $91 million of unrestricted cash and cash equivalents, and $605 million of undrawn capacity on our unsecured revolving credit facility. We also have $195 million of construction loan capacity, of which our share is $53 million. Turning to our outlook. For the fourth quarter, we expect FFO per diluted share to range from 9 cents to 13 cents per diluted share. We anticipate fourth quarter NOI for our Quixote business to moderately improve as compared to our third quarter results due to the improved production activity that Victor and Mark highlighted. We expect fourth quarter NOI for our in-service office and studio portfolios to remain at levels consistent with the third quarter results, adjusted for previously mentioned straight-line rent reserves. We anticipate having lower office occupancy in the fourth quarter, reflecting the full building tenant vacating Met Park North in early December. But for this early termination and the designation of Foothill Research Center as held for sale, we believe our office occupancy would have shown another sequential increase. Similarly, solely due to the removal of Foothill Research Park from our same-store pool, we are updating the range of the same-store property cash NOI growth to a negative 13 to 14% from a negative 12.5 to 13.5%. As always, our outlook excludes the impact of any potential dispositions, acquisitions, financings, and/or capital markets activity. And now I'll turn the call back to Victor.
Thank you, Harud. Each quarter, we are executing office leasing, and we are on track to significantly outperform our activity last year, along with the West Coast office fundamentals that are undoubtedly strengthening. On the studio side, we have contracts or interest in nearly 80% of our film and TV stages, while Los Angeles production levels are challenging but improving, and the proposed state tax credit legislation and potential City of LA incentives stand to meaningfully boost demand. And based on these factors, we believe we are on path to stabilize and start to grow occupancy and cash flow across our entire portfolio next year. And with that, the momentum of asset sales, our positive discussions with JV partners and lenders, we expect to have the balance sheet and liquidity to achieve our business objectives.